Hey everyone! Today I want to share some exciting insights about an ETF that's flying under the radar, but has immense potential for growth in the coming years. I've been doubling down on this ETF, and I'm confident that it's poised for significant returns. Let's dive into why I'm all in on this ETF and the compelling data that supports my decision. First, let's talk about the current economic landscape. The latest Consumer Price Index, CPI, report shows that U.S. inflation cooled in May, raising hopes that price pressures are easing. Overall inflation was 3.3% compared to the same time last year, which is a positive sign. This report comes just before the Federal Reserve's pivotal decision on interest rates, and it's a crucial piece of the puzzle for investors. When the Fed lowers interest rates, it tends to energize equity investors and push stock prices higher. We're on the brink of a significant shift in the stock market, and today's CPI data confirms this trend. While we can't be absolutely certain, the current trends suggest that now is a prime time to invest in stocks and ETFs heavily. One ETF that stands out, in particular, is SCHD, the Schwab U.S. Dividend Equity ETF. This ETF has been overlooked recently due to its lackluster performance, but it's time to bring it back into focus. SCHD recently reconstituted its holdings, aiming to produce a sustainable 4% dividend yield long-term. It's already risen to 3.82% in just a couple of months. Analysts predict a 6% share price appreciation growth per year for SCHD, combined with a 4% dividend, giving a total return of 10% in a relatively safe, value-style fund. The key advantage of SCHD is its focus on high-yield dividend blue-chip stocks. These are companies with a history of providing solid dividends, which makes SCHD an attractive option for investors seeking both cash flow and price appreciation. The reconstitution of its holdings aimed to increase its dividend yield, making it even more appealing. Now, let's talk about the potential economic impact of the Fed cutting interest rates. When rates are lowered, high-yield savings accounts, bonds, and money market accounts become less attractive as their rates drop from 4-5% to around 1-2%. This shift makes dividend ETFs like SCHD more appealing to investors looking for better returns. Currently, there's over $9 trillion in money market funds, accounts, and CDs. While not all of this money will flow into the stock market, a significant portion is likely to move towards better investment options like SCHD. This influx can drive the ETF's performance higher, benefiting investors. Even if a recession occurs, consumer staples tend to perform well because people still need to buy essential items. This defensive characteristic makes SCHD a smart choice for investors looking to weather economic uncertainties. Moreover, SCHD's diversification away from the high-flying tech stocks provides a balanced approach. While tech stocks have driven much of the market's growth recently, they can't continue at the same pace indefinitely. SCHD offers stability with its focus on value and dividend-paying stocks. SCHD's growth prospects remain strong. Analysts predict a 6% price appreciation growth per year, combined with a 4% dividend yield. This total return of 10% makes it an attractive option for conservative investors. Additionally, SCHD's income growth rate of 6% is significantly higher than the long-term inflation expectations, making it a solid hedge against inflation. I'm personally investing heavily in SCHD for a few reasons. First, it's not overly inflated with tech stocks, providing a safer option in my diversified portfolio. Second, SCHD's recent underperformance has created a good buying opportunity. As more investors recognize its potential, I believe SCHD will see significant price appreciation. To wrap it up, SCHD is the gold standard of high-yield dividend blue-chip ETFs. It offers a balanced approach with a focus on consumer staples and value stocks. With the potential for significant returns, it's a smart addition to any portfolio, especially in times of economic uncertainty. Let's delve deeper into SCHD's strategic advantages. The ETF's methodology focuses on selecting high-quality companies with strong fundamentals, such as consistent dividend payments and robust financial health. This disciplined approach ensures that the fund is populated with reliable dividend-paying companies that have a proven track record of weathering economic downturns. Furthermore, SCHD's expense ratio is notably low, making it a cost-effective choice for investors. With an expense ratio of just 0.06%, investors can retain more of their returns compared to higher-cost funds. This low expense ratio, combined with the ETF's strong dividend yield, makes SCHD an attractive option for those seeking to maximize their investment returns. The ETF's top holdings reflect its focus on stability and income generation. Companies like Pfizer, Verizon, and Procter & Gamble are known for their consistent dividend payouts and solid financials. These companies provide a cushion against market volatility, offering investors peace of mind during uncertain times. Additionally, SCHD's sector diversification is another key strength. While consumer staples represent a significant portion of the ETF's holdings, it also includes exposure to other defensive sectors like utilities and healthcare. This diversification helps to mitigate risks associated with sector-specific downturns, providing a more stable investment experience. The ETF's recent underperformance presents a unique buying opportunity. Market sentiment can sometimes overshadow the fundamentals, leading to mispriced assets. In the case of SCHD, the recent dip in performance is not indicative of its long-term potential. As market conditions stabilize and investors seek reliable income sources, SCHD's value proposition becomes even more compelling. Looking ahead, the macroeconomic environment is likely to favor dividend-paying stocks. With the Fed potentially lowering interest rates, the search for yield will intensify. Investors will increasingly turn to dividend ETFs like SCHD to satisfy their income needs. This shift in investor preference can drive demand for SCHD, pushing its price higher and benefiting current investors. Moreover, SCHD's income growth rate of 6% is particularly noteworthy. In an era where inflation remains a concern, the ability of SCHD to grow its income faster than the inflation rate provides a crucial advantage. This feature makes SCHD an effective tool for preserving purchasing power and generating real returns. In conclusion, SCHD is a robust investment option that combines the stability of high-yield dividend stocks with the growth potential of value stocks. Its strategic focus on consumer staples, low expense ratio, and strong dividend yield make it a standout choice for conservative investors. As we navigate the current economic landscape, SCHD's balanced approach and defensive characteristics position it well to deliver solid returns. If you're looking for a safe, reliable ETF with solid growth potential, consider adding SCHD to your portfolio. It's positioned to benefit from the economic shifts we're anticipating, and it can provide both cash flow and price appreciation. Thank you for watching, and if you have any questions or thoughts about SCHD or investing in general, feel free to leave a comment. Happy investing, and see you next time.